This is part 1 of topic 11, and in this topic we're looking at exchange rates, and in this particular presentation we're looking at the first 4 dot points. First of all, exchange rate determination, and we're going to learn how exchange rates are basically determined by the forces of demand and supply, just like any other price. The exchange rate, or an exchange rate, is the price of one currency in terms of another. So an exchange rate is a price. And then next we've got 3 exchange rate systems: floating, fixed and managed. And just to give examples, floating, an example of that is Australia; fixed, an example is either China or Hong Kong; and managed, Singapore is a good example. Okay, so we have a demand and supply diagram here, and we're looking at US dollars per 1 Australian dollar, and I've got an exchange rate of 89 US cents equals 1 Australian dollar. And what we can see here is that the demand curve for the Australian dollar in the foreign exchange market is downward sloping, the supply curve is upward sloping. Now we have a situation where the demand and supply at equilibrium are both $200, and as we'll learn more in the next topic, this intersection point of $200 is actually quite important, quite insightful. When $200 is demanded in the foreign exchange market, what we're going to, or the way we're going to interpret that in this course, is that that demand of $200 for the Australian dollar must mean that foreigners are demanding 200 Australian dollars because they actually want to send $200 into Australia. Okay, so if a foreigner is demanding the Australian dollar, $200 worth of Australian dollars, and they're going to pay for that using some foreign currency, then that person must have the intent of spending that $200 in Australia. Now I know that there are minor exceptions to that kind of logic, but generally that is true. So demand $200 is flowing into Australia as the foreigner who demands the 200, or the foreigners, it's probably multiple foreigners who are demanding this 200, say, billion dollars of Australian dollars. Those foreigners will want to buy something Australian. So it could be a good, a service, or some sort of asset that they want to buy, hence they need $200. The supply is the opposite side of the coin. Australians generally supply the Aussie dollar in the foreign exchange market, and that must mean that the $200 being supplied by Australians is being used to purchase foreign currency, and therefore the $200 that is being supplied is money that is leaving the country. So we're in a nice situation with a floating exchange rate whereby demand, the amount of money coming into Australia from overseas, equals supply, the amount of money flowing out of Australia. So that's why I've got down here, inflows and outflows both equal $200. So with the floating exchange rate system, yes, the exchange rate does go up and down in response to demand and supply, but what that exchange rate is actually doing on a daily basis is balancing the inflows and outflows of money from Australia. So we're in a situation where the net flows of money are generally close to zero on a week-to-week basis. Okay, now let's consider some of the main driving forces behind exchange rates. So what are the main factors that actually move the value of the Australian dollar? The first one I've got is economic growth, and an increase in GDP growth in Australia increases both the demand for the Australian dollar and the supply of the Australian dollar. Why is there an increase in supply? Well, with stronger GDP growth, chances are there's going to be very strong income growth, and as Australians have more income because of the stronger GDP growth, they will purchase more imports, and as Australians purchase more imports, it increases the supply of the Australian dollar. At the same time, with very strong economic growth, it's likely that foreigners will want to invest a lot more money in Australia's stock markets, for example, as well as more direct type investments, that is purchasing businesses outright. So there will be an increase in the demand for the Australian dollar, as foreigners send more investment money into Australia, attracted by the very strong economic growth. The net effect, well, generally it's an appreciation. Generally, when economic growth is strong in a country, the increase in demand dwarfs the increase in supply in terms of size, and therefore the overall effect will be an appreciation of the Australian dollar. Okay, the next one, inflation rates, relative inflation rates. So what I've got here is a situation in which there's lower inflation in Australia than in the United States. As I've got on the right here, that has two effects. It decreases the supply of the Australian dollar and it increases the demand. The net effect is an appreciation because both the decrease in supply and the increase in demand act in the same direction on the exchange rate, i.e. they both appreciate the exchange rate. So why is there a decrease in supply? With a lower inflation rate in Australia, that is going to make Australian goods and services relatively cheaper for Australians to purchase. So rather than going to, say, New Zealand on a skiing holiday, maybe you will stay in Australia, even though the snow's not as good, stay in Australia and go on a skiing holiday in Australia instead. So there's this geographical shift in consumption patterns, and as Australians purchase more Australian goods and more Australian goods and services and assets, and fewer foreign goods and services and assets, the supply curve of the Aussie dollar shifts to the left. At the same time, foreigners, they start buying more Australian goods and services, and that increases the demand and shifts the demand curve to the right. Actually, with this example of inflation rates, this is mainly going to act on goods and services, not assets. So I'm just correcting something I said previously. So we will have geographically a shift in consumption patterns from foreign goods and services to domestic goods and services. You wouldn't expect inflation rates to significantly affect too many asset prices, although it could affect housing prices. That could be affected by inflation rates, so maybe lower inflation in Australia leads to lower growth in housing prices, perhaps, although it could work the other way. But that is the main reason behind inflation, lower inflation in the country causing an appreciation. Obviously, high inflation works the other way and depreciates a currency. Another reason why high inflation is undesirable, because it will lead to a depreciation of a country's currency and make everything that we want to buy from overseas more expensive. Okay, and then we've got interest rates. We've got an increase in interest rates in Australia relative to the US. That is going to decrease the supply, increase the demand, and cause an appreciation of the exchange rate. The reason why, with higher interest rates in Australia, there is a decrease in supply because Australian citizens invest their money in financial assets that are paying the higher interest rate, so higher domestic assets that is, and foreigners send more of their money into Australia chasing this higher interest rate. That increases the demand for the Australian dollar. Net effect, an appreciation. So economic growth, inflation and interest rates are three of the main factors that drive exchange rates. They're certainly not the only factors, but they are three of the main ones. There are other factors. Commodity prices is a good example in Australia. If commodity prices go up, you would expect there to be an increase in the demand for the Australian dollar, because foreigners would need more Australian dollars to buy the same amount of commodities, the same volume of commodities, when prices are higher. Okay, next we have a fixed exchange rate system. So with a floating exchange rate system, you should have read quite a bit about that in the case of Australia. The Reserve Bank of Australia puts out plenty of information about Australia's exchange rate. So I encourage you to read widely on Australia's exchange rate system. But now we're dealing with a fixed exchange rate system such as Hong Kong. We've got the demand supply curve, but the government has decided to fix the exchange rate at 7.8 Hong Kong dollars per $1 US. Okay, so the way this actually works is that in the case of Hong Kong, they have a currency board, and the currency board's objective is to keep the exchange rate fixed at 7.8%. So if there is an increase in the demand for the Hong Kong dollar, just imagine the demand curve moving to the right, to prevent the appreciation of the Hong Kong dollar against the US dollar and the breakdown of the fixed exchange rate system, the currency board would have to then increase the supply by the same amount. How will they increase the supply? Well, they would go into the foreign exchange markets with their reserves of Hong Kong dollars and use those and supply those Hong Kong dollars to the market, and in return take hold of some sort of foreign currency, US dollars, euros. So every time there's an increase in demand, there's got to be the same sized increase in supply. Okay, and here I'm talking about perhaps a run on the currency. Let's just imagine if foreigners decided that they didn't want to invest in Hong Kong anymore, and there was a substantial leftward shift in the demand curve. Now, rather than just abandoning the fixed exchange rate system, the Hong Kong Currency Board could actually use its exchange rate reserves, its foreign exchange rate reserves, to shift the demand curve back to the right, which is what I've got here. So the demand curve initially shifts to the left because foreign investors reduce their willingness to invest in Hong Kong, and then the currency board steps in and shifts the demand curve back to the right to maintain the pegged exchange rate, and they do that by using their foreign exchange reserves, that is, their holding of US dollars and euros, to purchase their own currency, the Hong Kong dollar. So that's a fixed exchange rate system. With a managed exchange rate system, such as Singapore, Singapore has an upper and a lower bound. So the demand and supply curves are allowed to move around over time, but the exchange rate is not allowed to go below the lower bound or above the upper bound. Now, this is a managed exchange rate system, and the Singaporean central bank will actually intervene in the market and manipulate demand and supply to keep the exchange rate between the upper and lower bound. Now, if you want to learn about how they do that, I've got a link down the bottom here, a web link to a PDF document, and you can read more about Singapore's exchange rate system. But just quickly, let's talk about not how they do this, but why they do it. They do it to maintain low inflation, and there is more information on the link that I've got at the bottom of the slide on what I'm about to talk about. Now, in Singapore, around about 50 cents in every dollar that is spent in Singapore is spent on imported goods. So when you holiday in Singapore, when you buy food, chances are it's imported. When you buy bottled water, chances are it's coming from somewhere else in Asia, perhaps a plant in Malaysia. So because Singapore is a very small economy, and it's very reliant on imports and exports, importing and exporting are a very important part of their economy. Now, the way this works is that, just imagine that the Singapore dollar was allowed to depreciate by 30%. So 30% being well below the lower bound. So just imagine a big leftward shift in the demand curve. The Singaporean dollar, or the equilibrium in this diagram, drops below this lower bound, and we get a 30% depreciation. What impact would that have on inflation? Well, with a 30% depreciation, that means that import prices would increase by 30%. And because imports are roughly represent half of the size of the Singaporean economy, with import prices going up by 30%, we could expect a roughly 15% additional inflation. What if the Singaporean dollar was allowed to appreciate by 30% due to either a big decrease in the supply or a big increase in demand? Well, with an appreciation, we would have a situation where import prices would fall by 30%, given a 30% appreciation. Import prices fall by 30%, and we could then expect that to contribute to quite strong deflation. And if the appreciation was large enough, Singapore could actually get into a situation where inflation becomes negative or they actually experience deflation. If you still don't understand why deflation is a problem, I urge you to do some reading about that. So what we can see is if the Singaporean dollar drops too low, it can cause inflation. If it drops too high, it can cause deflation. And that's why the Singaporean dollar is controlled within this upper and lower bound. Now I've got question marks next to this upper and lower bound because the Singaporean central bank doesn't actually announce what these upper and lower bounds are. The Singaporean dollar is actually managed against a trade-weighted basket of currencies, not the US dollar. It's a trade-weighted basket of currencies. So that's a managed exchange rate system. And as far as Singapore goes, because they actually manage their exchange rates so carefully, they don't really have the ability to move interest rates independently of interest rates in the rest of the world. So what we've got here is a diagram from one of those Monetary Authority of Singapore publications. I've got a link to the Monetary Authority of Singapore website down here. So one of those publications is this graph, and it just shows interest rate movements. So SIBOR is an interest rate and the domestic interbank rate is an interest rate. So in red, that is the Singaporean interest rate. In blue, that's effectively the US interest rate. So what you can see here is that the Singaporean interest rate doesn't move too far out of line with US interest rates. The reason for that is that interest rates in Singapore are constantly being adjusted so that they don't put any pressure on the Singaporean dollar to move outside this upper and lower bound. So rather than being free to move interest rates in Singapore up and down to control inflation, interest rates in Singapore have to be moved up and down to keep the exchange rate within this upper and lower bound over time. So by having a highly managed exchange rate system like this, it really does hamper your ability to use interest rates to target inflation in the way that it is done in Australia.